And actually, do me a favor. When we you can
Okay,
pin
we
a
are live now.
a comment. So unless there's another one that you want to pin for the meantime, um, pin the one that with all the links in it, if you wouldn't mind.
I don't know if I can pin the comment from the interface I have now.
But you could do it through Facebook. I mean, it's not a big deal, but you can.
Okay. Okay, I'll try. Okay, so we are
Oh, here we
live.
go. Yep, I
Yeah,
see.
we are live and we can share.
Okay, cool. All right. Okay. Ready? I don't mind waiting if you want.
Hello, everybody. I'm back again tonight with Jeff Epstein of Activist, hashtag MMT. And we're going to be talking about the Fed again. Jeff has a lot of questions for me. And the context of the discussion are some videos by Graham Elwood. And Jeff has kindly put in the comments the links to those videos. And I will add the links to my description for tonight once this video is done. So I think we'll probably wait a minute or two for more people to arrive. And then we'll get started in earnest. Hi, Dolores. Hi, Jeff. Hi, Kay. Hi, Lana.
Okay. Hi, Lana. Lana, I didn't think you were going to be here.
Thank you all for coming. I'm not sure she's going to be able to stay for too long.
Oh, well. Nice surprise.
It is a nice surprise. You're quite right. And I think a few other friends have joined. Oh, I don't see them yet on my comment thread, but my numbers are telling me that they are nevertheless probably here. So,
So how's coronavirus, Joe?
how's coronavirus? Not very good in the United States right now.
We're just approaching, I believe, 70,000. Is that right? 60,000, 70,000, something like that.
I don't know. It could very well be. I mean, it's doubling every couple, 3 days now. So it could certainly be 70,000. I didn't see the figures for today. I watched part of John Campbell's video, but didn't get to see the whole thing today because we were busy with some other things. Stephen Campbell has joined. Hi, Stephen. Nice to see you. Oh, Lana had to do business tax return analysis training. Oh, yeah, that's pretty bad.
75,000 in New Jersey.
75,000 new cases in Jersey.
75,000 confirmed cases in
that's
Jersey.
That's amazing.
So New York is likely approaching 200,000 now.
Yeah,
and they just announced
we know
today.
Those are underestimates.
And they just announced
still
today
not testing very much.
That their shutdown is going to be until May 15th, as if, like they didn't know that before.
Yeah, well, Cuomo will be fighting with Trump continuously over when the economy of New York State is going to open up. It's not going to be easy. Okay, let's get started. I think we have a quorum. Warren Chamberlain has joined, and Barbara Wernick has joined. Sandy Degg has joined.
Hello, all.
So I think we're ready with a very active group at this point. I'm sure a lot more will be joining us. Please share, everyone. Of course, goes without saying. And when the YouTube video goes up later, please share, like, and subscribe. And don't forget my Patreon account, which is at patreon.com/Joe_Firestone. Thank you very much for anything that you can do. Okay, and Jeff, if you'd like to also give people your Patreon identifiers, that would be fine.
Sure. My page on Facebook is Activist MMT, spelled like that. And on Twitter, it's Activist MMT, one word. And my Patreon is patreon.com/activistmmt. And I just released part 2 with us today, our first post AMI monetary reform one. I just released it today. In fact, I'll put
yes, I noticed you had it on Twitter.
I will put those links in there.
And I believe I retweeted it. Of course. And you can put those links in as well.
Sure.
Okay, you have questions for me. Lots and lots of questions for me.
Yeah, it's going to take a few years, but we'll see what we can get done tonight.
Okay.
Excuse me. Just give me a moment if you wouldn't mind before.
Okay, Matt Waldy is here. Hi, Matt. Dale Weaver is here also. Lana says New Jersey is scary. My sister is there.
And I believe she's in North Jersey where it's all happening, which is near New York. I'm in mid-South Jersey, whereas we're getting up there with 1,000 in my county, but it's all up, where near New York is where it's all really going crazy.
Yeah, my cousins are in Freehold, New Jersey.
I believe that's north.
I think it's a little more central, maybe. Not quite north. It may be more to the north. Certainly not around Philadelphia.
I'm ready in just a moment.
Sandy is asking, where is your sister in New Jersey? Okay, Ivlana.
I know that she comes from North Jersey. When we spoke, I remember that she mentioned North Jersey, but I don't know specifically where. But I'm pretty sure it's relatively close to New York, and that is definitely where the huge outbreaks are happening.
Right, but Lana lives in Minnesota now.
Correct, but she comes from
Yes.
there, so I presume that her sister is in that area. So, okay. Before we get started, I actually want to ask just one follow-up question.
One follow-up question, okay.
I want to ask one follow-up question from, I just released, no, I didn't just release it. I just finished editing the first half of where I interviewed you about you.
Okay.
And I have one follow-up question from that, and that is, you encountered books in the mid-1990s that all gave hints of that what we understand about the economy is wrong. But you never, you said you said that the pieces came together when you discovered MMT in 2010.
Yes, I was ready, Kay, for MMT.
The pump was primed, as you said, yeah.
Yeah, I first encountered it at the end of 2009.
My question specifically is, what about MMT made it all come together for you?
Okay, it was actually Warren's book. Actually, his two books, the soft currency book and the 7 deadly innocent frauds. Okay, and I guess what made that make the whole of MMT come together is that everything seemed to be related, okay, to everything else. And I could see the synthesis in Warren's work, and I could appreciate it, and I immediately saw that it meant that austerity was bunk, balancing the budget was bunk, reducing the deficit was bunk. And so it really freed me up to be as radical as I wanted to be in 2010. I was already pretty radical in 2009, you understand. Okay, but of course, then I was still just a little bit worried about the size of deficits, things like that.
So what specific concepts in MMT gave you, what were the concepts in MMT that put it together? You say the books brought it together for you, but were there specific concepts that put it together?
Well, the first concept, of course, was the idea that the federal government actually creates the currency. That was a pretty fundamental notion, and of course I immediately connected it to Article 1, Section 8, because I'm a political scientist. So that made, an immense amount of sense to me. In fact, it removed the contradiction why people were claiming that our capacity to spend was limited, when basically Article 1, Section 8 said that our capacity to spend wasn't limited. Okay. And then as I learned about some of the aspects of, the existence of a debt ceiling, okay, for example, why did it make sense to have a debt ceiling? And I realized, of course, very quickly, it didn't make sense to have a debt ceiling. It was an arbitrary something that was placed on the Congress during the First World War, actually, by progressives, okay, in order to make sure that too much spending power didn't fall into the hands of the executive branch. Okay, and it actually started off as a liberalization, because it used to be the case that when the presidency wanted to do some deficit spending, it would have to go to the Congress to specifically authorize the piece of spending, okay, that it wanted to do. And so the progressives then tried to liberalize it, by saying, oh, well, what we're going to do is pass a debt ceiling. And the president during the First World War would be able to spend the appropriations, okay, that we offered, and he wouldn't have to worry about the size of the deficit until he bumped up against the debt ceiling.
Okay.
Okay, so I began to realize that, but also in Warren's books, the issue of inflation, okay, was addressed, and I began to see that it wasn't really necessary for us to have inflation, that it depended on more than simply printing money. And really, from my early days, okay, in MMT, it became clear to me that there were multiple causes of inflation. I discovered MMT in December of 2000, okay, and 9, and by the end of March 2009, I was quite clear that inflation was actually not a problem.
2010.
Yeah, 2010. And then when we held our fiscal sustainability conference, okay, and Bill and Warren were there, okay, and Marshall Auerbach gave a specific presentation on the causes of inflation. I then became very, very clear about the multiplicity of causes, okay, of inflation. And it wasn't just the presentations at that conference, it was also the discussion. There was voluminous discussion from the audience of, really intelligent people firing questions, okay, at the MMTers. And the MMT people answering the questions, okay, with ease. Most of the major issues of MMT, actually right up to the present, were covered at that conference.
Mm-hmm. Okay, great.
So that's what actually made things come together for me. That plus the fact that I began to write some MMT in the early spring of 2010. When you write about something, you start to understand it better.
Mm-hmm. Okay,
I was
great.
writing like mad during the spring of 2010.
Great. All right. Thank you. Thank you. Okay, so the reason that I wanted to talk tonight, Graham Elwood, I introduced Graham Elwood to MMT in June of 2018.
Mm.
And it was an amazing experience. And he really took to it. And he's come a long way. He, with confidence now, says, we don't want to spend on war because it's immoral. We don't need their money. Before I met him, he would say, we need to stop spending on war because we need that money to do education and so on. He now confidently understands that. Like, he says that with confidence, and it's a real pleasure to see that. He just released two videos on the Federal Reserve's response to coronavirus, which are in the pinned comment on this live stream on Facebook. And his videos on the Federal Reserve, in one sense, are wonderful. That he really gets that our government has the power to do whatever it wants to do, and they could do the orders of magnitude more than we believe that they can because we have all the resources literally in the world to do it. But the way that he says it and the way that he understands it is through a very wrong frame. And I get that it's a wrong frame, and he's focusing on the Federal Reserve as if that is sort of the center of government. And I see it as the correct overall assessment with really, really incorrect details. Like the anger is the correct anger and the general assessment is the correct general assessment, but it is focused in the wrong place. And I am struggling myself to grasp how large an issue this is. So I would like to get a picture. I mean, I want to address some specific stuff that he mentioned, but I would like to just more generally get an overall picture of the Federal Reserve's role and the more overall picture in which that role exists. Because my understanding is that what the Federal Reserve is doing, well, actually, if anyone knows, you know the game Minecraft? Are you familiar with the game Minecraft?
I'm not entirely familiar
But
with it.
you get the concept of it. It's basically infinite Legos. It's a video game of infinite Legos. Okay, it's a really wonderful game, but it's just an infinite world where you can build Legos. It's amazing. But
yeah, my granddaughters are experts at it.
Yeah, my son is great at it, and actually, if I let myself, I could spend a few years on it as well. But the point that the reason I'm bringing this up is because not when I played it, but now in the the more recent versions of it, you can create a portal, and when you go through this portal, you go into it's called the Nether world, and what it is basically, roughly, the world negative. It's like the negative of our current world. And I think of what the Federal Reserve does is in that nether world. It's in that negative world, the banking system. So all of the Federal Reserve put $1.5 trillion into reserves, into the banking system, whatever it is, and guaranteed that they would purchase assets back and all the specific things that they do. What Graham believes, and what many people believe, is that they put $1.5 trillion into the hands of bankers, executives at the banks. And the Federal Reserve could have chosen to put that $1.5 trillion into canceling student debt, for instance. And clearly that's incorrect.
Yes, it is.
That money, as I understand it, stays in that nether world. It doesn't leave that negative world, that nether world. It stays in the banking system. However, I do think to some extent what the Federal Reserve does in that in the reserve system does to some extent cover up for bad behavior. And, like, for example, people and businesses don't want to take out loans right now for obvious reasons. But instead of addressing the underlying causes of not wanting to take out those loans, instead, the Federal Reserve, because it's its job, I don't think it's nefarious necessarily, is greasing the wheels for the banks. They're not solving these underlying problems. So it's like encouraging the banks to make loans more easy, even though there's a reason that people aren't taking out loans. There's underlying causes. So, I mean, that's a lot. But I'm actually really struggling. Part of my struggle is to put my head around this whole thing. So I want to address the specific points. Like, I'll give one example. Maybe we could start from there. Graham mentioned in one of his videos, which I know that you saw, he was upset because the Federal Reserve overnight put in an extra $50 billion into the system so the markets can be stable. And he was upset that Congress bickers for decades, generations on end, but the Federal Reserve overnight can put in $50 billion extra. That overnight is a process. That overnight settlement is a process that they're referring to, not the speed of overnight, an unusual speed. And another thing that he said was 2 weeks for repos, that they were putting an extra, I don't know, 60 billion, whatever it is. And again, 2 weeks refers to some kind of part of this process, that like the average balance of a bank is what determines how much reserves it has to have. So that's a lot out there. I am struggling to get my head around it, to know what those questions are, but I would like to be able to give an introduction to, this entirety of this system and where the real problems are, for the purpose of refocusing that correct anger in a more accurate direction.
Okay, and what's your question?
Yeah. Uh, well, let me see if I get the overnight settlement is for example, if someone gives a paycheck from a company is a bank account in Wells Fargo, I have a bank account in PNC. My bank, I'll get the paycheck, I'll hand it to my bank. The bank will say you'll get it in around 24 hours, and it's that settlement process overnight that exchanges the $1,000 my paycheck in reserves from Wells Fargo to my bank, and that settlement process, that overnight settlement, is what is actually giving me my money from my company. Is that much accurate? Just that much.
Yeah, that much okay is accurate, but what's going on, of course, in terms of the mechanics of it, is that the banking system is going through and is marking down the money in the account that is paying you.
So the Wells Fargo, the company has a bank account at Wells Fargo. Wells Fargo's reserves go down.
Yeah,
My
Wells
bank's
Fargo's reserves goes down, and also the account of the payer who's paying you, okay, is marked down.
right.
Okay, uh, okay, and also the reserves at your bank will go up.
And then my claims on those reserves go up as well.
You don't actually have any claims on those reserves,
Well, I have
but
$1,000 in claims on those reserves from my paycheck. That's how I understand it.
no, not really. What happens is that you get your account actually marked up, but not with those reserves. In other words, the reserves that are marked up, okay, at your bank, those are reserves that always stay in the banking system. Okay, in other words, the actual reserves that are in what you call, essentially the netherworld.
Mhm.
Those are reserves that were produced at one time or another by one of the Fed banks. They're high-powered money,
Mhm.
and they are markups on accounts, and they never get out of the Federal Reserve System, itself. But your bank account is outside of the Federal Reserve System, and you don't have any high-powered money, okay, in your account.
I thought, I
What
thought,
you have in your account is bank credits.
so there's, okay, so then I didn't understand this. What I thought was that there's you know, well, PNC reserves, just a huge glob, $600 billion, whatever it is. And then everybody has their accounts. I have $1,000 in my account. I thought my $1,000 in my account was just the number 1,000, which was a claim on $1,000 of those reserves, which I could withdraw at any time.
You can, okay, you do have a claim on the $1,000, and you can get cash actually from your bank, okay, for the $1,000 in most situations, okay, well, partly cash, okay, but the actual reserves, uh, the credits that are in your account,
Mhm.
okay, are only bank credits. They're not the same, okay, as the reserves that are in the banking system.
So there's
Okay, so in other words, the reserves at your bank, in your bank's actual reserve account, which is at the Fed,
mhm.
those reserves do not get touched by you, okay, or by any other customer in the banking system.
So that implies that there's another, like a bank credit account, or is it just I have my thousand and
There's
there's
another layer. There's another layer comprised, okay, of our depositor accounts or checking accounts that is actually below the layer of the Federal Reserves. okay, that were actually created by the Fed banks. Okay, these reserves sit in the accounts that your bank has at the Fed.
Okay.
Okay, in other words, all the banks that are in the banking system, that are part of the banking system, have accounts at one of the Fed regional banks.
Right.
And it's in those accounts that the high powered reserves actually sit. And they are locked into that system in which those reserves circulate.
But that $600 billion, let's say this bank has a total of 600 billion in reserves.
Yes.
I thought that by definition meant that there was, roughly speaking, $600 billion in all of the accounts at all of the branches for all the customers.
Oh no, there's much more than that.
Oh, that's a percentage. That's a percentage. That's a percentage. So let's say that's 10%, for example. But still, that is 10% of all of the accounts at all the branches for all the customers. So I thought that the total of all of the customers equaled that 600 billion times, I know that's 10% of the total. But you're saying that they don't have claims
Well,
directly on
okay,
that
it
reserve.
may equal that. Uh, okay, in other words, there's a requirement, okay, that it equal 10% or 3%, okay, or whatever the figure is now, okay. But that particular requirement may not be satisfied, okay, at any point in the day. In other words, there's not a one-to-one correspondence, okay, of
Okay.
what is supposed to be in the reserve accounts of the banks and what is actually in the reserve accounts of the banks and what is in the checking accounts of the customers, okay, or the
So
deposit accounts
so there's
of
something
the customers.
intermediate. There's something intermediary between the reserves and my account. What is that intermediary thing?
The intermediary between what's in your bank's accounts, okay, the reserves in your bank account, I'm sorry, in your bank's account at the Fed, okay, and the credits that are in your account,
Mhm.
the intermediary is the bank's ability to mark up your account and mark down the account.
So how is that? This just seems like different ways of saying the same thing. That I have a thousand.
Not different ways of saying the same thing because it's very fundamental to MMT that the credits in your bank account, okay, are bank credits and don't have the same degree of faith behind them, or don't have the same degree of authority behind them, okay, as the particular reserves that were created by the Fed banks, which sit in the reserve accounts of your bank. In other words, what sits in the reserve account, okay, at your bank is the high-powered money of the federal government.
Guaranteed up to
What
100%, I'm guessing. So for me, it's only
Well,
guaranteed up
okay,
to.
I mean, it's not that it's guaranteed up to 100%. It is money. Okay, it is the high-powered federal money created by the Fed banks. But what's in your bank account is not the high-powered money that was created by the Fed banks.
Ooh, okay, I am missing something. I know that my. Okay, I don't know. I don't understand.
Okay, so it's really simple to understand. Okay, what's in your bank, okay, are credits that were assigned to your account by your bank.
Yeah.
Okay, what's in your bank's account at one of the Federal Reserve banks, okay, are credits that were assigned by one of the Fed banks. And those credits, okay, that were assigned, okay, by one of the Fed banks, those are credits that have the full faith and credit of the federal government behind them.
Right.
The credits in your account do not have the full faith and credit of the federal government behind it.
Because it's guaranteed only up to 250,000.
Sure.
Okay. Okay. I I feel like keep pushing that, but that there are too many other things to go with.
Okay.
So okay. Um,
Okay, so this is covered, Kay. Should you want to read about this, Stephanie Kelton in 1998
in her
or 9 wrote a short paper on the hierarchy, okay, of money.
okay, then I'll just take a
And
look
if
at
you
that.
read that paper on the hierarchy, okay, of money, she will explain this.
Okay, that helps. That helps. I won't
And
worry
she
about it
explains it
here.
with clarity,
All right,
with her usual crystalline clarity.
all right. I will read that. Good. Um, okay. So the overnight settlement, I think, I generally understand that. The 2 week window, I believe, is also generally correct, and I actually remember this. I think partially from a footnote in Stephanie Kelton's paper, "Can Taxes and Bonds Finance Government Spending?" about this 2 week like window, that the average balance over that 2 weeks, because it's impossible. Like there's no real snapshot because things are happening all the time. So they
Right.
have this 2 week window that they determine an average balance for a bank's reserves, and
Okay.
that is what the percentage of reserves is based upon. So
Right.
that's this 2 week window that, again, that was mistaken as they can do things in 2 weeks. But no, it's a specific process. It's a specific part of this plumbing process.
Yeah, basically what it is okay, it's an evaluation of whether the bank actually has the whether the bank has met the actual requirement for having the reserves that it's supposed to have
Right.
actually sitting at its account in the Fed bank.
Okay. That's fair.
Okay?
Yep, that makes sense. Can you just briefly, I don't think it makes sense to go too deep into this, but just a brief understanding or definition of repo. And my understanding, which is an inconvenient term, or an unfortunate term because it brings up repossession, which I don't think has anything to do with. It has to do with, I believe, something to the effect of basically a trick that they do is they purchase something and then immediately do it back, give it back. Can you define, just briefly define what a repo is?
Sure.
Because it actually put it in context. In Graham's video, in the article that he's quoting, it says 2 week repo.
Right. Okay, what happens is that when banks find themselves short of the reserves that they're required to have, what they do is they go into the overnight the funds market, which is also known as the repo market. And the reason why it's called the repo market is because they can get a short-term loan, okay, from another bank, okay, in that particular market, okay, at a very good interest rate. Okay, but they have to pay it back within the 2 week time period, or whatever the time frame is that they actually negotiate, okay, the loan for.
And the Fed purchases an existing. I think it's an exchange, right? It's an exchange, and then
It's an
they must exchange it
exchange
back
between about two banks.
between
Okay,
two
if
banks. Oh, I thought it was between the Federal Reserve and one of its
no,
banks.
it's not between the Federal Reserve, okay, and one of the banks. It's between one bank that goes into the market to get some more reserves in order to meet, okay, the requirement that it has fallen short of.
Okay, so
Okay,
this
and
is
some other bank that has more reserves than it needs, okay, to meet its particular requirement.
huh.
So it would like to earn some interests. So it earns some interests by lending money to a bank that is short. And the interest is small, of course, in terms of interest rate, but the volumes are very, very large. So that kind of lending then can earn, considerable money for some of the banks that are very high in terms of the reserves they hold.
Okay.
Okay, now, there's something else, though, to keep in mind here, and that is that when the repo markets freeze up, okay, or start to freeze up, then
And
banks,
let's actually, what it means to freeze up is that banks are simply, they don't want to purchase anything from anybody else for whatever reason.
when it frees up, it's because the banks that have an excess don't want to offer the excess in the market because they're insecure and feel that they're going to need that excess.
Okay.
Okay,
Okay.
and they cannot spare the excess; they have to hold on to it. So banks that are short, okay, are not able to borrow in the repo market, okay, which is an overnight market basically.
Okay.
Okay, so they're not able to meet the percentage that they're supposed to have.
Okay.
Okay, so what do the banks do then? They turn to the Federal Reserve then, and they go to what is known as the discount window. And they can always borrow money from the discount window. The rub is that they pay a little more in interest. And the second rub is that their status as a bank falls when they have to go to the discount window. Okay, it's considered as somehow something less than a prestigious thing to do, to go to the discount window, okay, and borrow money from the Federal Reserve itself.
How are
However,
they?
the Federal Reserve, just because it wants to maintain stability in the banking system, is really, from an operational point of view, it's always required to make those loans. There's no rule to that effect. Okay, but of course, it has the responsibility of keeping stability in the market, so it can't allow these markets to freeze up.
How are
So
they?
it's got to free up the reserves, okay, for banks that are in trouble and are not able to meet their 10% or 3%, okay, or whatever the requirement is at this point.
You said that they're penalized in some way, and actually, you're reminding me of reading Nathan Tankas's blog that they're in this crisis. They're trying to unstigmatize the discount window. How
Yes.
how are they? You said that they were penalized in some way. Can you review just how they were penalized, or the stigma, or whatever it is, the negative for doing it?
Okay, well, there were two negatives for doing it. The first
Higher
negative
interest rate
was just status.
status.
Okay, and the second negative was that they would have to pay a higher interest rate, slightly higher, okay, than what's available in the overnight funds market.
Okay.
Okay, it's always a little more. It's set by the Fed at a little higher rate, okay, than what's available in the overnight funds market.
And what do you mean by status?
Okay, what I mean by status is that when a bank has to go to the discount window, somehow it's thought that such a bank is weaker because it wasn't able to get some other bank to lend it money in the overnight funds market.
So perception. Okay,
It's
perception.
perception, yeah. It's a
Okay.
perception. It's status.
Okay. Okay, that makes sense. Okay, so enough about that. You know what? Just oops.
Okay, you're readjusting.
All right. Okay, so maybe we could. All right. So what is the consequence? Let's just go from a child's point of view. What is the consequence of this market freezing up? like what happens in this worst case scenario that people panic and they go to their banks and it's not an issue of money can be created, but what is the real world consequence if this this market truly froze up and they weren't able to meet their requirements or whatever it is? Like what is the extreme situation of what would go wrong? And I know I'm pretty confident that it's catastrophic.
The extreme case is that the bank would be in violation of the law or the rules, and so it would constitute essentially an excuse for regulators to come in and reorganize that bank.
But I mean on a broader scale, if this market froze up, what would happen?
If the market froze, uh, well, if the Fed were to allow the market to freeze, then there would be many, many banks, in violation of the rules, and they would be looked at uh, as approaching insolvency.
What is
This would create a crisis of confidence in the banking system, and banks would start to fail. That's why the Federal Reserve has to keep the discount window open at all times.
What does insolvency mean in a government that can create, issue currency? What does that
It's
mean?
not the insolvency of the federal government, it's the insolvency of the private banks we're talking about here.
Hmm. Okay. And so since the central government can issue currency, then it is easy for them to prevent this situation.
Right, and the Fed specifically is tasked with actually preventing this situation by keeping the discount window open.
Okay. All right. All right.
So in other words, they have a requirement they have to meet, but if they fail to meet it, then the Federal Reserve stands ready to give them the money it needs, they need in order to meet, the requirement.
Okay.
So the requirement is something of a paper requirement, and it is not a prior constraint on lending at all. It's a post facto constraint, which essentially requires them to go into the loanable funds market at first, the overnight market, to borrow reserves, and in the extreme to go to the discount window, to borrow reserves.
Okay. One follow up with repo, which is you said the repo market is you said it's between banks. That is how banks negotiate with each other to access reserves so they can each, have the amounts that they want and to meet requirements and so on.
Right.
But I don't understand then what it means for the Fed to make extra money available to this process.
Okay. Sometimes it happens that the Fed can see that there's a scarcity of money in the overnight funds market. And then the Fed will become afraid that there might be a seizing up. And so what they will do then is to make reserves available but to the private banks. Now, they don't simply grant the reserves to the banks. What they do is they give them those reserves in return for financial securities which the banks are holding. Quite often, these particular securities are treasury bonds, but they might be financial securities, of other kind, as well. And the Federal Reserve is swapping essentially the equivalent of cash in return for paper instruments that have a market value that's supposed to be equivalent.
Okay. And so they're basically exchanging a savings that makes interest, an asset that makes interest for reserves that make less interest or no interest. And then that swap is a prerequisite or a pre-step which
Oh, well,
gives that.
actually, what the Fed is doing, okay, when it wants to loosen up the markets, okay, or increase the liquidity in the markets, okay, is what they call it, is they are basically selling reserves to the banks in return for the financial instruments. Then the Fed takes ownership of the financial instruments and places the financial instruments,
Got
okay,
it.
on its balance sheet, okay, as assets.
Okay, and then that bank now has extra reserves, which encourages it to sell those excess to other banks that really need it. I think I have that now.
That's right, or gives those reserves actually directly to banks that may have been short of those, but that had plenty of financial instruments, okay, that were lying
Got it.
around.
Yeah, makes
So,
sense. They,
right.
they go significantly up, so it either meets requirements or it gives them excess, which they can sell. I got
All
it.
right, and when that happens as a coordinated long-term kind of campaign, it's known as quantitative easing. That's what quantitative easing is.
Oh, really?
Yeah,
Wow, I
yeah.
understand
Like
something now. I understand something.
we're doing $500 billion of quantitative easing. What
Wow.
basically the Fed is announcing there is that we're going into the market and we're going to give 500 billion in these reserves to these banks in return for financial instruments that they're going to give us, which have the same paper value, a
So
paper
okay,
value of 500 billion.
so now we're getting okay.
Now we're
So
getting somewhere, right?
I understand. I actually understand quantitative easing for the first time. So is there a situation where a bank needs more reserves and they don't have the assets to exchange for those reserves?
There may be a situation like that, in which case they would have to go to the discount window.
Ah, okay. That's the backstop. That's the backstop.
Now, that's the
So
backstop.
they can take out a loan if they don't have the assets themselves and pay a little bit more, maybe lose a little bit of
Right,
status and
but
so on.
there are some times when the banks don't have the assets to exchange, and where there's a sufficient shortage of assets that the banks fall below the capital requirements they have, okay, as opposed to the reserve requirements.
Capital
They
means
get
the
weak in the
things that
capital requirements.
I need to make sure I understand what capital is. Is that the securities and whatever that they can exchange for reserves and repo?
Okay, the capital is the actually net financial assets which the bank has on its books.
Such as like the building and so on, like physical stuff,
Not simply
partially.
the building, but the financial instruments too. Okay, in
Okay.
other words, those are assets. So you take the total of the assets and you subtract, okay, the liabilities of the bank.
Okay.
Okay, and
So
then each bank has to have a positive figure. It has to have net financial assets, okay, that are positive.
okay. So paper
And
and
that's
physical stuff, like the building, in addition to. Got it.
right, okay, and that's the capital, okay, of the bank.
Okay.
So there are capital requirements. That's part of the law, okay, as well as the reserve. Okay, there's a requirement, okay, for reserves, okay, against loans, but there are also capital requirements. If
Mm.
they fall below the capital requirements, that's when they really get to an insolvency situation, when they begin to approach, okay, an insolvency situation. And that's really when, there's a choice of whether they call in, the liquidators, they declare bankruptcy, or, banks declare bankruptcy. Now, the large banks don't, because the government is basically protecting them all over the place. But in the crisis of 2009 and 2010, a huge number of smaller banks went into bankruptcy. There was no protection for them.
And someone asked in the comments, I believe it was Kay, like what happens when there's a run on the bank. So in this particular situation, all those people get up to 250,000, and then they lose everything above that. It's that simple.
Not really, because the federal government in that situation would try to back the depositors to the greatest extent possible. They would go way over the 250,000 in practice.
Okay. Okay. So let me slightly go to a different angle here. All of these things, huge repo, destigmatizing the discount window,
Yeah.
which is what's happening now. And as I'm learning in Nathan Tankis's Substack, what are so okay? So this is the plumbing. This is the behind the scenes stuff. This is the netherworld. This money does not leave the banking system, the reserve system, but to some extent, it is a reflection of real world bad stuff. And I'm sure that a significant amount of that is criminality and just treating people badly and like this that I'm sure that this coronavirus relief bill and all the actions of the Fed is not just relieving these banks because of the coronavirus, but covering up for the past decade of bad behavior, which I actually think David Diane's article that you referred me to mentions. So can you connect? Can you give a sense of, some of it is obviously legitimate and necessary, but some of it is covering for bad behavior. And
Okay.
I'm trying to bring this, to what Graham has mentioned of
Right.
this.
Okay. So banks over a period of time will make very many good loans, of course. The heavy majority, okay, are good loans. In other words, they're loans that actually perform well. Okay, people pay them back. But they also make some bad loans. And some banks make a lot more bad loans, okay, than other banks. And when the banks make a bad loan, they have to charge off that loan as a loss. And the loss reduces their capital. If they get enough losses, okay, then eventually their capital falls below the capital requirements that banks have to maintain.
Okay.
And then there's trouble because the banks are looking at failures, okay, bank failures.
I would presume that the big banks do this more and that the Fed covers them more in
I don't
this
know if the
situation.
big banks do it any more than the small banks, but the truth is that the big banks are protected far more than the small banks. Yes.
Okay.
Okay, so the small banks have to be more careful and have to be safer, okay, to stay in business. Okay,
Okay.
and not only because they may fail, okay, but because the really successful ones are often acquired by the big banks. And the
Hmm.
owners of the successful small banks, okay, would like to be acquired by the big banks because that's how those owners can get rich.
Okay. All right. So maybe we could back up a little bit. Like, I feel like I've gotten a little bit of the pieces here now. You watch Graham's videos. You have the context of what I'm going for here. What is he missing? What is the more overall picture? Where do we refocus this correct anger? Like, can we get a
Okay, so I think what Graham is missing is he thinks that when the Federal Reserve is creating money out of thin air, okay, to place inside to place inside of the banking system, he's ignoring the fact that when the Fed actually does that, it's doing a swap for financial instruments or other assets, okay, which the banks have. So it's not giving the banks money. Okay, it's doing a trade with the banks. Okay, the reserves, the high-powered money, in return for assets that are held by the banks.
and that's in all of these examples that he's upset about? that he not upset. I mean, whatever. But all the examples that he mentioned of
Okay, I
increasing.
can't actually remember whether this is the case in all the examples he's talking about, but in many of the examples, okay, he's
Okay,
talking about
these are
what's going on is a swap.
these big numbers, the
Okay,
1.5
it's not a
trillion,
grant.
the increasing of it by 100 billion to 150 billion, the increasing of whatever. These are all swaps. They can do as much as they want as long as
When
it's
the
swaps.
Fed is doing it, when the Fed is doing it with the private banks, and Congress, okay, is not involved,
Right.
these are all swaps.
Got it.
Okay. Now they would not be swaps if the Fed were, if the Congress were to order the Fed to simply give the big banks $500 billion or something like that. Okay, but Congress hasn't done anything like that yet.
All right, that makes sense. That makes sense.
Okay, now we ought to discuss though what's going on now. Okay, in other words, the shenanigans, okay, that are going on now with the 454 billion.
Yes, and actually, before you even get started, that that great naked capitalism article, maybe you referred it to me of believe it's Marshall Auerbach's assessment of the bailout bill, and that this
Yeah.
$450 billion, which you're going to talk about, and how it potentially expands to 4 trillion. There is no public records requests allowed on this particular money. None.
Yeah, not yet, but of course, the Fed and the Treasury are under extreme pressure right now to make those records public. It's not actually something that is required, okay, in the law, but they're facing a lot of pressure for transparency on this now. And whether they'll be able to resist that political pressure or not, I don't know. It depends on how loud the outcry is.
Interesting. I haven't seen that. Okay.
Yeah. Oh,
So
there's
the
outcry
400.
going on in Common Dreams right now.
Oh, interesting. Okay. So $454 billion.
Yeah. The $454 billion is something that was appropriated by the Congress for use by the Treasury to establish a loan facility at the Fed, which the Fed would be able to use to lend money to large corporations at very favorable rates of interest, close to zero interest. Okay, in this particular situation, the Fed was to place, okay, a requirement. Okay, what the Fed wanted was to have a requirement that they would be able to make loans 10 times as great as the capital that the Treasury Department was going to place at the Fed.
Okay.
So
That's the
basically, the
expanding to
Treasury
4 trillion.
Department was appropriated $454 billion
Right.
to give to the Fed. Okay, so that $454 goes on the balance sheet of the Fed.
Right.
Okay, and then the Fed was to use that to lend out $4.5 trillion or $4.6 trillion to the big banks to stabilize the economy in this time of, I shouldn't say to the big banks, to the big corporations in this time of need. Corporations like, for example, Boeing. Okay, corporations like the automobile companies, if they were facing difficulties.
I've heard, I don't know if this is the right context, but I've heard airlines and cruise corporations.
There was a special bailout for the airlines. Okay, in other words, the original total was $500 billion, but $46 billion of the 500 billion was then specifically directed towards the airlines,
Right.
okay, and towards, I don't know, it could have been the cruise industry as well. But 46 billion was taken out of the 500 billion and directed in that way. And that's why you get this uneven figure of 454 billion,
Okay.
which was going to go over to the Fed and sit at the Fed to back essentially these loans. Why did the Fed want the 454 billion to back these loans? Okay, because the Fed wanted its balance sheet to basically be protected. They wanted to be guaranteed against the losses that might come about from these loans of $4.6 trillion, and they figured 10% capital from the Treasury would cover any possible things that could go wrong with these loans.
So this is like in the false narrative of or whatever, maybe it's real in some context, of banks, keeping 10% of gold in their vaults, but giving out 10 times that amount, and on the hopes that no more than that 10% would ever come to the bank at any one time to retrieve that gold. This seems equivalent to that.
It's something very like that in concept. I think the idea from the Fed's standpoint is, look, we know some of these loans are going to be bad loans. We know some of these businesses, okay, are not going to survive. Okay, now we probably think, in actual fact, that the losses we'll experience on this will be something like 3%. So let's ask for 10%, so we cannot possibly lose this capital. Okay, because we can't afford to touch our capital. So that's basically what the Fed was probably saying to Congress people, okay, and to Treasury people, and saying, hey, we need 454 billion, okay, in order to be sure that we can sustain the losses that we're going to have to sustain by lending out this $4.6 trillion to these irresponsible big businesses that are certainly going to have some substantial losses. And we don't want it to hurt our balance sheet.
I understand.
That's basically what happened.
I understand. So it's not like expanding this. It doesn't make this 454. They're not like investing it and it gradually grows to $4.5 trillion. That has nothing to do with it.
Nothing to do with it. What they're doing is they're lending this money to the big corporations, which will have to pay that back.
And they're gambling that they'll only have, for example, a 3% loss, and therefore covering their losses with 3.33 times that. And they have faith that they're going to be okay. Got it. I got it.
They have faith that they're going to be okay, that it's never going to get up to 10%. Okay, right. So they think they're going to make a profit on this deal. The Fed will make a profit on this deal and increase its capital.
Which, I mean, they don't need a profit, but they don't want to
have a loss.
Yeah,
they don't want to have a loss.
Avoid the loss is more than have a profit. Yeah.
Right.
Okay, so
of course they could always ask for $1 trillion coin to cover any loss they might experience.
There you go. Okay, so please continue. So all the Fed does without the permission of Congress, or without new permission of Congress, is swaps. This $1.5 trillion is swaps. This increasing the overnight liquidity is just giving them is swapping their assets so they can exchange reserves.
What the Fed does is it does these swaps and it also lends. So it's authorized by Congress to do those two things. Okay, and that is basically what it does. And of course, in order to lend, it can create the loan funds out of thin air.
Right.
Which is what it does by marking up the accounts.
Okay, so this lending facility that was created by this bailout bill, how does that fit into this picture of repos, which is just
Oh,
run of the
it's
mill.
entirely separate from
So, okay,
repos.
so repos is just exchanging on a regular basis.
Yeah, in other
The
words, that's
discount
the
win
normal routine business of banks.
as long as they have the capital requirements in order to meet that, which I feel so smart saying that. And then the secondary fallback is the discount window,
Yes.
which is just another basically loan facility. And I think again this requires the capital. This is actually the more important place where capital requirements are part of the picture. Repo is less capital. Um, and then there's this separate lending facility that was created by this bailout.
Yes.
Okay. Okay. So this overall picture. So this focus on the Fed being the center of the world, where it's really part of a larger picture that includes Congress, that includes.
The Treasury Department. Yes. Okay. And okay, to get back to the larger picture, when you're interested in getting net financial assets from the government into the private sector, what that is about is the appropriation, okay, of money by the Congress in greater amounts than Congress taxes back from the private sector. In other words, a federal deficit leaves net financial assets in the private sector, in somebody's hands in the private sector.
Okay.
So that's how new monetary wealth is actually produced.
So this anger that banks are being helped and the people aren't being helped, big corps are being helped and people aren't being helped, is actually more properly focused on Congress.
Well, I wouldn't say it's entirely properly focused, okay, on Congress, okay, because when the Fed is bailing out the very large banks, what it's enabling them to do quite frequently, okay, is to make loans to corporations, okay, and also to each other, so the banks can earn interest. And that interest, okay, not only saves the banks and keeps them stable, but it keeps them in an operational state so they can continue to earn interest and increase their net earnings. And that in turn leads to profits over time and leads to increases in their capital over time, or at least, okay, it can do so. So there's kind of a balance. In other words, what's going on with the banks is they take chances and they do these bad loans and they, go to the derivatives market and they gamble in the international gambling casino, okay, of the derivatives market. And some of their bets turn out badly and they lose capital, okay, and then they have to be bailed out. And they generally don't turn, well, they turn to Congress to bail them out, but then Congress will basically try to bail them out by backing up the Federal Reserve so the Federal Reserve can lend them money to do various other things which may bring them earnings and and a situation where their profits are rising again and their capital, okay, is rising again. Certainly, many of the big banks in the banking system were in trouble as a result of the crash of 2008. And if honest solvency tests had been given to the big banks, likely 4 out of the 5 biggest banks would have had to go into receivership. Instead, what the Federal Reserve did and what the federal government did, okay, was to allow the Federal Reserve to create this huge credit facility for the banks to use, where over time, in the form of a revolving credit fund, they used more than $30 trillion in credit facilities.
QE.
Not but QE, partly QE, but revolving credit facilities, basically, totaling $30 trillion over just a few years, and probably a lot more than that over the time from 2010, okay, up to the present. And that, of course, helped the banks by helping their cash flow and allowing them to take a greater amount of risk, which in turn built their profits up. Okay. Also, look what they allowed the banks to do in the credit card markets. They were basically allowing the banks to get funds at very, very close to zero, and then the credit card subsidiaries of the banks would turn around, and we're getting to the point by 2019 where the average interest rates they were charging on those credit cards for people were 21%. So they
But
were getting the funds at close to zero when they borrowed those funds, and they were lending them out to many, many people at at 21%. The arbitrage on that was fantastic, and the potential profits on it were fantastic.
but that I don't understand the significance of why you're bringing that up in this particular context, such as like that's a bad thing, but that's a bad thing because the banks are basically usury, and the Congress is allowing them to do usury.
Exactly.
But I don't see how that seems like a non sequitur within this story, but I know it's not. I don't see how it's
Well, it's
connected
not
within this story.
entirely a non sequitur in the story, because what happens basically is that uh, since the banks are very large and they have a lot of disposable cash flow, some of that cash flow finds its way into the hands, okay, of the politicians. Okay, the politicians can be corralled in support of the banks using two kinds of threats. One, if you don't support us, okay, we're going to go out of business, and the whole system is going to crash, and the economy is going to go in the tank, and you guys are going to lose your seats because you'll take the blame for the economy going into the tank. Okay, and then of course the other thing they have on the politicians is they also have the carrots. And besides, if you do what we want you to do, then we'll support you with donations.
So this continuing of bailing out and ignoring usury and ignoring irresponsible loans and ignoring stock buybacks
Yes,
and
it's because, as Dick Durbin once said, in I think it was 2004 or 2005, he said, the banks run this place. He said that out loud.
right, but that's
Okay, I think that was just after Joe Biden's bankruptcy reform bill was passed.
yeah. Okay. Okay.
Okay, so the point is there's a big circle jerk, okay, that's going on here. Okay, and the banks are partly to blame, and the Federal Reserve is partly to blame, and the Congress, okay, is partly to blame. And we are also partly to blame because we don't watch what's going on,
And we
and we
don't
don't
demand
put
better.
in politicians who will stop it. And basically, the way to stop it is to fully nationalize the Federal Reserve and to nationalize the big banks.
Okay.
And I am all for that nationalization. I mean, I am. I know a lot of the MMTers are not, because they point out that, well, the banks can be made a neutral party in all this if we have control of the Congress and the right policies are followed, okay, and the executive, okay, is the right executive, and we have the right people, okay, inside of the judiciary. So if we take over the whole government, we can end most of the abuse, and that probably is really true. But the kind of abuse we see now, it seems to me, is always going to come back, okay, if in the end we don't simply nationalize the banking system.
But how is it possible to nationalize the banking system until we get into that same situation where we're basically in control of all these things so
We
that
get into
we
the
can make that happen?
situation, yes. So when we're in control of the system, then at that point, we ought to nationalize the banking system so it doesn't go back to the old state. So it
Okay.
cannot possibly go back to the old state.
So it's just a matter of when we get control. You believe that should be done, and MTers believe that something roughly different should be done.
No, I
But it's
think
both
that
but it's
no, no,
both
no, 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 no. Okay, I want to make a correction there. Some of the MMTers agree with me. Okay, for example, okay, I think that Bill Mitchell believes that the Federal Reserve banks should be unambiguously government banks, and he wouldn't mind at all if they were placed inside of the Treasury Department, or at least that's what I take from reading his stuff. Okay, now Bill is clearly a social democrat. In other words, he explicitly said to me in a car once when I drove him from the airport to the hotel for the Fiscal Sustainability Conference, he said to me, "Oh, I'm a social democrat."
Mm-hmm.
Okay, he was quite explicit about it. So for a social democrat to say that he believes in nationalizing the Fed, that's not a great stretch.
Okay, but all of this is predicated on we have to get control, and at that point, then we make a decision of which direction to go in, and
You're right.
AMI would choose the Need Act at that point.
Yeah, they would choose the Need Act. We would probably not. What we would choose to do is to, instead of having a fight over the Need Act, we would quickly pass all kinds of things that people need in order to build up our political credit, okay, and our social credit. Okay, and then over a period of time when everybody's happy and they think that our regime is the greatest thing since sliced bread, at that point we introduce the nationalization of the banks. Okay, but this is a matter of political strategy.
I
Okay,
remember I remember this from our AMI conversation. I remember this concept from our AMI conversation.
okay.
Yeah. Okay. So these swaps, these repos, these asset swaps are all for the purpose of easing the interbank trading of reserves, which in another way of saying that is to control interest rates. Is that accurate?
It's part of the process of controlling the interest rates. But there's a very easy thing to do, which is done in Canada, by the way. Put in a requirement, okay, for reserves at zero. Okay, in other words, lower the requirement of reserves, okay, to zero. Okay, and then you would have this scramble in the interbank market to borrow reserves back and forth. The banks would not need to have a particular level, okay, of reserves. Okay, and this was actually advocated also, okay, by Warren Mosler, okay, points this out. He doesn't favor the specific kinds of, he doesn't actually favor having a reserve type of a requirement. He wants to strengthen the capital requirements so the banks would be safer from the capital point of view.
Okay, so as long as we can guarantee that they actually have more real world stuff, roughly speaking, real world stuff, then the need for this fake artificial human created reserves would be less necessary.
Well, there would always be a need for reserves, okay, because the Federal Reserve banks themselves have to be in a position to supply hard money to the banks. Okay, it's just that there wouldn't be a requirement for a particular amount, okay, of the hard money, but certain reserves are needed to make payments. So, but for example, when you pay your taxes, okay, you don't have access to reserves generally, but your bank has access to reserves. And those are the reserves that get marked down by the Federal Reserve so that the Treasury account can be credited with entirely new reserves, okay, that are created by the Fed.
Okay. So in Canada, they have zero reserve requirement.
Yes,
Do
they
they
do.
have higher capital requirements?
I don't really know if they have any higher capital requirements, but Warren has advocated for higher capital requirements here and for getting rid of the reserve requirements.
Okay, so we just had a long conversation of why this, you know, this repo market is to facilitate reserve trading. Trading might
We
be not the
did.
right word, but
Yeah, we
and
did.
the discount window is to facilitate this ability of banks to trade reserves, to exchange reserves, because if they didn't do that, they could become insolvent and banks would go
Well,
bankrupt. They go into receivership.
the reason why that could happen, okay, is because if they don't conform to the rules, then people would lose confidence in the banks. And as if it were known that a bank wasn't meeting, okay, the requirements that it has to meet under the law, then people would become afraid, okay, that the people who resolve the banks, okay, would come in, okay, to resolve them, because they're breaking the law. And so the banks would not be able to do business. Okay, but if there were no requirement, okay, for reserves, that would not enter into the picture, okay, at all. Okay, then it would be strictly a matter of whether they met the capital requirements. So then they would have to be very much concerned about their profits, okay, and losses.
Okay, so
And
they would actually have to compete on a more, better services, better returns basis. And so in Canada, it logically seems that they must have more capital requirements, and even if they don't legally have them, that is what the banks must do in order to stay in business.
yes, I think so, for the private banks to stay in business. Now, if the banks were nationalized, okay, if they were nationalized by the government, then I don't think they would have any capital requirements. In other words, they would not necessarily even have to have any capital requirements.
Because why?
Well, because the government could always create the money they needed to operate.
Hmm. Interesting.
Right? I mean, it's like the Defense Department doesn't have any capital requirements, really. All it has is the requirement for the appropriation from Congress.
Hmm.
I
Wow.
mean, it has to have its appropriation every year, has to have its money every year,
Right.
but it
All right.
gets
Well,
that money through the appropriations process, and then the Fed actually topping up the Treasury spending account.
I'd like to go back to repeat a question that I had before. So, this the Fed does all of these asset swaps, secondarily the discount window, and in this special situation, this loan facility for the coronavirus relief bill. So all of these things facilitate banks exchanging reserves in order to meet their requirements. Is that equivalent to saying the Federal Reserve does all these things, forgetting the coronavirus thing? The Federal Reserve does the repo and the discount window in order to help the banks, prevent this market from freezing up. Is it equivalent to say that the Federal Reserve does this in order to defend its interest rate?
It's part of defending, okay, its interest rate. uh, but also it's mandated to defend the stability of the banking system apart from, okay, its interest rate. And the stability of the banking system actually means, of course, that one doesn't have a general round of failures, okay, in the banking system. That there'd be a limit to the failures in the banking system. It's okay for them to allow some of the banks to fail, but not too many of the banks. And of course, the very big banks are too big to fail because that would cause a crisis of confidence in the whole system. So they can't allow the big banks to fail as long as they operate, okay, in the current way. Now, if they were to allow the big banks to fail, then the big banks would have to be taken over by the government and they would have to be resolved, okay, in some way. And then the government would have the choice of retaining ownership of the big banks, either one or more of the big banks, or spinning off the big banks to private capital and breaking them up, okay, in the process. And there are people who favor different kinds of policies. Again, there are some people who favor, well, if we take over the big banks, why don't we simply nationalize them and keep them? And there are other people who say, well, it's really better to decentralize authority and power and break up the big banks into multiple small banks. Okay, of course, once you do that, then banks tend to concentrate again over a period of years, and then you have to do it again.
I just want to take a quick aside, and Kay just said, "I love the looks on your face, Jeff." And this is the looks on my face when I'm struggling to keep all of the new knowledge in and not let it fall out the other side. All right, let me ask you again.
Sure.
So the Fed does these things to the swaps to facilitate banks exchanging reserves in order to meet their requirements. To some extent, they're doing this is ignoring or allowing bad behavior.
They're doing a lousy job of regulating the behavior of the banks.
Please. This, yes.
Okay, in other words, the Fed has the power to regulate and to stop these banks from going into the high level financial trains, okay, that they're doing. Okay. The Fed has the power to make the banks boring again. Okay, and it doesn't want to do that. It still allows them to do the complicated financial instrument deals. Okay, go into the gambling casino, the international gambling casino, and swap these complicated financial instruments.
Huh.
It seems to me the Fed ought to stop that.
But but they're allowed to do this. So Congress allows them to do this, right?
Yeah, Congress did allow them to do this. There was a particular act that was passed in the latter stages of the Clinton administration called the Commodity Financial Modernization Act or something like that. There were two basic critical banking bills passed by Clinton in the final stages, of the administration, with agreements from Newt Gingrich. He was collaborating, with Newt Gingrich on that. One of the banks repealed the Glass-Steagall Act that had protected us from banking crashes, from stock market crashes, I should say, for so long. Okay, so they repealed that. And the second one was called, I think, the Commodity Financial Modernizations Transaction Act or something like that. Anyway, I'm close to the title. And that act is what allowed them to create these exotic financial instruments that they used
default swaps,
during the
chopping
decade of the 2000s, where they bundled the loans together in complicated packages, and statisticians told them that the chance of losses with the complicated bundles were far less than the chances of not actually doing the bundling.
Partially because, and I'm pretty sure this is correct, partially because it was so complicated that they could not understand the chain of title, which is so when people went to complain, the bank said, I don't know, right? I believe that that's partially correct. That
I
these
think it's
credit
partially
default swaps,
correct.
like they sold a home, a mortgage, and they chopped up that mortgage into other and mixed other mortgages together and did it over and over and over again,
And
sold
over
those things to
again,
bank.
and they lost track of the chain of title, and
And
then
there's
they
a whole
later
book
went
about
into
this.
court and they claimed they had title to properties that they didn't have title to, and then they robo-signed
Robo signed. That's how
all
I,
kinds of statements to the courts, and they committed wholesale fraud.
and nothing was done. And that's
And
how I
nothing was
discovered.
done. They've never been brought to justice for it, and many people lost their homes as a result of being in a process like that, including Graham Elwood.
Including Graham Elwood twice. Um,
Right.
and this is how I discovered naked capitalism was I believe it was the Citibank robo signing. They whistle blew or assisted whistleblowers with that. That's how I discovered naked capitalism. I would guess around 2011 or
Yeah, there
12
were
or
some
something.
very good articles about that. Some of them were by Dave Dayen, as I recall.
Oh, is that right? Okay. Yeah, no, it
Now
was not just
he
an
wasn't
article.
the only author. Okay, there were a number of authors gave articles like that.
Oh,
Okay, but
it was a
Dave was writing
long,
about that. Okay,
elaborate
at that
series.
time.
Yeah, it wasn't
Okay,
just an
and I think
article.
he wrote a book on the subject also. I think that was his first book.
Oh, interesting. So it actually partially came from naked capitalism. I didn't actually even realize that. Okay.
I don't think that book came from Naked Capitalism, but from
The experience somehow related to that experience.
yes, it did. I mean, it was part of the articles in Naked Capitalism were about the same subject. Okay, as Dave's writing in the book.
Okay. So again, you just said that, these laws were relaxed so that the Fed could regulate the banks, but regulate the banks means much less now, that they can take much riskier, much bigger
Well,
risks.
but the Dodd-Frank Act gave the Fed actually greater power to regulate the banks again. It didn't
Greater.
completely repeal the Commodity Financial Modernization Act, but it gave the Fed a greater authority to oversee what the banks were doing and to restrain the animal spirits of the banks somewhat.
Somewhat, but we're still in dire straits, even when that's where all that's
Not
concerned, I
only
would
that,
imagine.
yes, not only that, but of course the Fed under but Timmy Geithner didn't do very much of that because he was not inclined to do any of that or to use the kind of authority that was there for that.
Can you continue on what you were saying? The Fed does not regulate the banks very well, and so partially it's a choice, but partially it is Congress's mandate. And so this anger being focused on the Fed is doing what it is mandated to do. So you're saying
Yes,
they're
but
not
it's not.
regulating the
It's
banks
not
very
okay.
well.
The
Hold on,
Fed
hold on,
has
hold on.
got.
Let me just
All
finish.
right.
So you're saying the banks are not being regulated very well, but that is their mandate. So again, Congress is who provides their mandate. So it seems to me, simplistically, just to get this going again, that's where the anger should be directed again.
Okay, certainly part of the anger should be directed there. Okay, but also part of the anger should also be directed at the Fed, and the reason why is because the Fed, okay, is an executive agency basically, and the Congress, okay, is the lawmakers. So the lawmakers say what the Fed should be regulating, but the
Oh,
fine
they're not
details,
executing it. The executive branch, they're not executing it properly.
they're not executing it properly. Congress should
Whoa.
have some oversight over that and should be complaining about what the Fed is doing. And Congress is not, in part because who would do the regulation? there could be, since 2019, House committees, okay, that might start to do it, okay, to some degree, but the Senate committees, okay, under Mitch McConnell, okay, are not going to do it. Okay, so in part, it depends upon who's in control of the Congress and who's in control of the financial committees, okay, of the Congress, who's in control, okay, of the oversight committees. Uh, okay, and even now, okay, with the House, I think the oversight committee, is that under control, okay, of Richie Neal? Okay, if that's under the control, okay, of Richie Neal, then he's not going to do much in the way of oversight, okay, on regulation.
I want to
Something like that.
clarify: the Federal Reserve is part of the executive branch.
Ah, that is another complex question.
Okay. Well,
And
okay.
I guess, okay, I'm going to throw that one at you because we have to get it clear. The Federal Reserve obviously is performing executive kinds, okay, of functions. It is an executive type of function. Okay? According to the Constitution, there are supposed to be three branches of the government. There's a legislative branch, the executive branch, okay, and the judicial branch. So why is not the Federal Reserve a part of the executive branch? And if it is a part of the executive branch, why isn't it under the supervision of the Secretary of the Treasury and the President? When Congress created the Federal Reserve in 1913, was it acting constitutionally? The Supreme Court has stayed away from litigating this question for more than 100 years. Doesn't want to litigate this question. It seems clear, though, it seems clear that there's not supposed to be an executive branch that's part of Congress. It seems clear that there's not supposed to be an executive function which is outside of the three branches, okay, of government. And clearly, the Federal Reserve isn't actually outside. It doesn't characterize itself as independent, characterizes itself as part of the government. The Board of Governors does anyway.
Creature
Okay.
of Congress.
So why isn't the Board of Governors under the Secretary of the Treasury? Why isn't the Board of Governors under the indirect supervision of the President?
It's not even a question of the Fed as a monolith. It's like pieces within the Fed are. It's complicated, even at a sub level, like the pieces of it.
Yes, it's complicated because the Federal Reserve banks, okay, strictly speaking, in other words, from one point of view, they're private banks because there are stockholders and those are private stockholders. But there are court decisions which state that these private stockholders are not like stockholders, okay, in regular companies, that they don't really own these banks in the same sense, that their stock is kind of similar to dues, okay, is the way it's, characterized by the courts. And the Federal Reserve banks themselves are characterized, okay, as agents of the federal government. In certain respects, in some contexts, they're agents of the federal government. In other contexts, they're viewed as private banks. The courts seem not to be able to make their mind up about that.
Okay, but as far as MMT and issuance of currency is concerned, they are a creature of Congress. I mean, that has to be true. Otherwise, MMT,
They are a creature of Congress. Okay, they are an agent. They're in their currency issuing functions. They're acting as agents of the federal government. Yes.
Okay. Whew. Okay, so again, Uh, so the Federal Reserve is not executing their mandate as well as they could. Congress is not. Congress gave them a very wide mandate, but in addition to giving them a wide mandate, they really don't have much oversight. So it's this problem is basically just everything really. It's just
Yeah, the Congress is not performing the oversight it should be performing, particularly over the Federal Reserve, which it should be mandating the Federal Reserve to actually regulate these banks much more tightly with respect to the kinds of transactions they do in order to better protect the capital of the banks so that the risk the banks are taking, okay, is lowered. They should be making banking boring again. They are not doing that.
okay. I can picture one question that is going to come up, and I'm going to struggle with it, and that is the Federal Reserve's job with its repos and all this big numbers, 1.5 trillion and so on, in the repo markets and the lending facilities and all this, is to fulfill its mandate of preserving the stability of the banking system.
Right.
Now, from a layperson's point of view, someone who doesn't understand this stuff, which my foot is well in that area of not understanding this stuff, but the lay people, general public, when you say the stability of the banking system, that still comes across, in my point of view, my instinct of, basically helping the bankers. And it's not a separate functionality of like this netherworld of this banking reserve system. So how would you introduce this concept of the stability of the banking system, that this is a plumbing underworld that does not, in a way, it covers up bad behavior in a way, but not nearly as directly as people think, and that this is separate from our everyday lives. How would you introduce this to people who really don't really know any of this yet?
Okay, well, the Fed, of course, when we say it has to maintain the stability of the banking system, okay, what we're saying is that it has to stop too many banks from failing, and big banks that would shake the system from failing, so that the credit functions of the bank don't seize up, and with them the flow of commerce, okay, and business.
The banking system as a collective.
The banking system as a collective, yes.
Okay, so this is not about. I mean, to an extent, it is, but in the larger picture, what the Fed is doing is preserving the stability of the banking system as a whole. It is not. It is not catering to individual bad actors at particular banks.
Right, but it's not the only way to actually protect, okay, the stability of the banking system. Congress could actually decide to nationalize all the banks. That would be another way of protecting the stability of the banking system, okay, because the banks won't need any capital, okay, and they won't need any reserves.
Okay.
Okay, but so the point is, given the kind of basically capitalist system that we have now with private banks, I'm taking that as a given, and given the mandate of the Fed to maintain the stability of the banking system and to maintain the stability of prices and to facilitate full employment, that's another mandate, okay, of the Federal Reserve.
Well, maximum, but yeah.
Well, I mean, by law, it was part of the Humphrey Hawkins bill.
It used to be full. It's no longer full.
I'm not saying whether it's any longer full, okay? I don't think it used to be full either in terms of actual full employment.
Okay.
But what I'm saying is that mandate for the Federal Reserve is on the books. And it's part of the reason why Jay Powell today is doing some of the things that he's doing, because he is trying to backstop the employment situation in certain areas. And he's doing it because he thinks it's part of his mandate.
Okay.
Okay? So it's complicated. Part of what the Federal Reserve is doing is certainly to ease the way of the banks and to help the cronies of people on the Board of Governors. So, get them out of some trouble they got themselves in. That's certainly a part of it. But there's also a public purpose kind of mandate, because if the banking system were to fail overnight, there would be hell to pay, okay, in the economy, and everybody would suffer.
Interesting.
Okay, now there are plans we could undertake to stop that, and changes and arrangements that we could make to stop that. But given the way the system operates now, when you get into a seizing up of the system, you have to decide what to do in the short run. And the Fed is mandated to do that. And so a lot of what it does is not by choice.
Okay.
Okay, it's operating in certain situations almost as if, okay, it's an automaton. Like, for example, theoretically, it could refuse to make loans at the discount window. But practically, if it wants to maintain the stability of the banking system, it can't really refuse to make those loans.
Wow. Okay.
Okay? So that's the kind of situation we find ourselves in, okay, with respect to that. One other remark I wanted to make, to get back to Graham's problem.
Please.
He thinks the Federal Reserve can just, make grants of net financial assets to people. Now, it can take certain actions which result in an indirect way in the banks or the big corporations actually gaining profits over a period of time. But it can't simply grant the money. Okay? But they could be granted money through actions of the Congress.
Congress can high-powered money, which by definition means there's not an accompanying debt to it.
What Congress could decide to do, for example, is to bail out, a company like AIG by having the Treasury buy some of its stock and give it all kinds of money in return for the stock. Or it could simply vote a grant to AIG or some other corporation to keep it in business. Okay, because, it believes the country is vital for the security of the country. For example, it could do that for Boeing. Okay, or some years ago, it did such a bailout, okay, I believe some time ago, for Ford and for Chrysler.
Okay, can you actually repeat?
And in 2008 for GM. I mean, it bailed the GM out.
So if you could just rewind and just the Graham, you said you wanted to make one more comment. Can you actually just repeat that for me, please?
Okay. I think what Graham is confusing.
Oh, the grants, that they can't, net financial assets, which just means give them money, no strings attached.
Yeah, the Federal Reserve can't do that.
Right, in normal activities.
Right, in normal activity. Okay, but it can do that if Congress appropriates the money for that kind, of purpose. Then the Federal Reserve can give reserve additions to the Treasury spending account
Who then gives
to
it to
give
the people.
to those corporations.
Right, and or to the people, which in this coronavirus thing, they gave us a pittance of $1,200 a person or whatever it is, $500 a kid.
Yeah,
Or at least at some point we're going to get it. At some point we'll get them our paper checks in this internet age.
Either get our paper checks or get our bank accounts actually marked up. Some people have gotten their bank accounts marked up already.
Okay.
They said
Okay.
some 60 million people got that done already this week. I'm
Okay.
wondering why I didn't get mine. Okay, because I was sure they had my bank coordinates, but you know.
Give me your account and routing, and I'll see what I can do.
Okay.
Okay. So once again, my head is completely spinning with lots of good stuff that, I feel like I have to let it settle, and then I'm going to have a whole new slew of more questions, but I feel like, we're close now. So is there any final things that you think would be good to sort of wrap this up as far as the specific topic, but also of the context of what I'm shooting for here as far as, taking the anger, that the correct anger that people have, and putting it in the right place? The answer seems to be pretty much everywhere, just government. That seems to be, it's partly the Fed, but it's also definitely partly the Congress. Part of it should be reserved for us because we're not, demanding better or standing up or whatever.
Right, but I think one other point is that if you look at the bailout bill they just passed, there was $350 billion in the bailout bill for loans to small business.
And I believe defined as 500 people or more is defined as small
500
business.
people or less, yes.
Oh, 500 people or less. So I didn't realize that.
Right, right. Okay, so the
Okay.
limit of that facility is businesses not having any more than 500 people.
Oh, okay. So that actually is truly small business. Okay.
Well, it's not truly small business because, it seems to me a business with 500 people or 450 people or 400 people is pretty large.
But
Okay,
it
but that's
includes,
another.
okay, granted, but it includes
Right,
actually one person, two people.
right.
Okay.
Okay. So, in loans going through that particular facility, they start out as loans. But if the small business people use those loans for expenses like paying rent and paying salaries, then those loans are supposed to turn into grants, not actually repayable to the government anymore.
If they keep their employees, I understood.
If they keep their employees and use the money to pay the salaries, okay, of their employees
Right.
and some other business expenses like pay their rent,
Right.
okay, then those loans will be turned into grants. So that's the government actually granting money to people to allow them to stay in business,
Which Congress can do. Right.
which Congress can do, but which comes through the Treasury Department.
Right.
That's coming through the Treasury Department.
Right.
Okay. Now, there's one other thing to mention as well, and that is there was a facility just created by Jay Powell, okay, and the Fed, and it was written up by Hockett. Okay, it's in a link.
Oh, that's in your description, I believe.
Right. Okay, that's in the description. It's a three-pager, and it describes a loan facility program that is being backed by, I think it's $75 billion from, okay, it's part of, I think $150 billion was allocated, okay, in the bailout bill to state, okay, and local governments. So I think they're taking $75 billion of that and they're giving it to the Fed. And the Fed is setting up a loan facility of up to 10 times the size. In other words, that 75 billion is there for
Percentage.
losses again.
Right. I understood. Okay. So they're predicting potentially 3%. So that's potentially that, triple that for 10%. Got it.
Okay, but it's not simple loan funds. In other words, what's going on is that the state governments and local governments over a certain size are supposed to issue securities, and then the Federal Reserve will use the leveraged money from the $75 billion to buy the securities directly from the state government, actually monetizing the facilities.
To ease pressure off of the states.
Ease pressure off the states, okay, and local governments. Now, it's significant, okay, to note here that the Fed is prohibited by law, okay, from actually monetizing the debt of the Treasury Department.
Define monetizing the debt.
Okay, monetizing a debt is the Fed directly buying Treasury securities from the Treasury Department. The Fed's not allowed to do that.
Okay.
In other words, what the Fed has to do is run these auctions and have the private sector buy the Treasury debt. And then sometime in the future, when the Fed does the quantitative easing, it then buys back the Treasury debt sometime later. But it's not allowed to buy the Treasury debt in a direct way from the Treasury.
Mm-hmm.
But in this facility, it's going to be allowed to buy the state and local government debt but directly. And that's what I mean, okay, by monetizing the debt.
Okay.
Okay. But also, there's something mentioned in Hackett's piece as well, that the Fed is looking forward to a situation where it might extend the term of these loans, which is initially pegged at 2 years, so that there's a possibility the loans could be rolled over and would not have to be paid back. And there's even a potential for a rollover that would keep on going. And so the state and local governments would never have to pay it back. So that would be a situation where basically the Fed would be giving net financial assets, in effect, to the state, okay, and local governments.
Interesting.
It's a very interesting development.
But okay, that's very interesting. I look forward to reading that paper. And that brings up, like, a lot of people are talking about canceling rent, canceling bills. Yeah. And the only one who could really make that happen without negative consequences is Congress. That's the only one. So, but they're not. So all of this pressure is being put on states. And I just find it, I have found it very interesting thinking about this. It's like, yeah, we should put pressure on states, but states can't issue currency. So they can only do so much, especially in this crisis situation. So all of these states are being pressured to cancel rent when we should really be gathering together and pressuring our Congress to cancel rent, because they're the only ones who can, they have to pay the rent, and then the landlords have to pay their bills, and then those have to pay their bills, and so on and on and on and on. And the only one who can, stop that cycle and not lose money in the process, lose savings in the process, is the issuer. That's the only one who can handle that.
Right. Okay. The issuer is the only one who can backstop this whole process, and everybody comes out whole.
Right. So everybody comes out whole, and
right.
And the side effect of this is that the states, in order to do this, they either have the money, which they likely don't, or they take out a bond or whatever, or they tax their people. And who are they going to tax? Ideally, they would tax.
What the states could do, okay, in other words, it depends upon the laws of the states, but the states would be able to declare, okay, a moratorium on rent payments, okay, or also on payments for water or, other utilities or things like that, okay, declare, okay, a moratorium on those.
But declaring a moratorium on rent then brings up the issue of what happens with the landlords that require that rent. And then again, that's that cycle of that has an effect, which has an effect, which has an effect.
Yes.
But my point is that this has the effect, the Fed not providing, has the effect of empowering the rich. Because what it does is states must provide more than they should otherwise have to, education, healthcare, So therefore, they require more in donations in order to provide those things. So therefore, who do they turn to? They turn to the rich people in their states, which ends up that the rich end up owning the state legislators, which
You're
means that
right.
the state legislators in turn, who are they going to tax? They're not going to tax the rich because the rich are in charge.
Right. So,
So,
what we have to do is go
which
to
is
the
why we have
Congress.
GoFundMe's. Which is why we have GoFundMe's.
Right. So, what we have to do is go to the Congress and get the Congress to appropriate the money,
Right.
which would allow people to have a moratorium on their rent and still keep their landlords whole, still keep their contracts
Right.
intact.
Right.
Okay, and we would do that if we don't want to basically confiscate what ought to be the assets of the landlords.
Right.
Of course, it's possible for government to make that kind of decision too, okay, if the political situation allows it, but our political situation doesn't allow that right
Right.
now.
Well, that's just another example of the one who could truly backstop the entire cycle, even not economic, but in this non-economic way, is the central government. But okay, so just a few unrelated comments, and then I think we'll stop for now. And number one, I want to thank Warren in the comments. He's been like Neo in the Matrix, like answering all these questions in the comments while we're talking, which is really good. So thank you to him.
Who's answering the questions?
Warren Chamberlain.
Oh, Warren Chamberlain. Oh, good.
Yeah, so he's been answering all these questions in the comments while we're talking.
Oh, good, Warren. Thank you.
Um, he said something, I don't recall what he said, that made me think of this, but there was a funny tweet today or yesterday that said something to the effect of, during this coronavirus, life is actually cheaper because we're not going out to restaurants, we're not driving our cars, and
Yeah.
So this person in this tweet said something to the effect of, oil is really taking a hit during this crisis, and in fact, it's taking so much of a hit they might have to start laying off some congressmen, which I thought was cute.
It is cute.
And I do think that there's something that I do get regarding Graham, which is the anger at these big numbers, 1.5 trillion, all these asset swap numbers. That's just completely misguided.
Yes.
That's just completely misguided, and I think I get that now. So, you told me to read Hierarchy of Money by Kelton. I'm going to look at that too.
Right. Okay. I think it's misguided. Okay, from the standpoint that these numbers actually mean something. In other words, the size of the numbers. Okay, actually mean something. In a sense, that's not really the point. Okay. The point is that the federal government stands ready to back the banks to keep them in business. And so they're not really an example of companies that are operating in any kind of free market. And since they're operating in such a way that the federal government has to protect them on a continuing basis, then what right do they have to be private companies? Why shouldn't they be entirely public, owned by the public? In that instance, since they're really completely dependent on the public for their very existence. And so that may be what getting at, Graham. Okay, fundamentally, he recognizes that someone who's a mortgage holder is not someone who's protected by the government. If the mortgage holder makes a mistake, and even if the mortgage holder doesn't, the mortgage holder can lose their house because of shenanigans that are coming out of these banks.
Wow.
Okay, and because of the fact that the government is protecting these banks even when they're committing fraud.
For decades on end.
Yeah, for decades on end. And the regular people, citizens of the United States, are getting victimized by this process.
These banks are doing criminal activity against citizens, but the banks are being made whole, and the citizens are not just
and
not
the citizens are left to suffer. That's what Obama did. He bailed
It,
out
it,
the damn banks.
it's not just that they're not being helped. It's that they're being they're having criminal activity done by these big institutions, and not just not being made whole, but no justice. The criminals get to rob us, and they're the ones who are made whole.
Yeah,
And they're
and that's what's getting that is what's getting him so exercised, so Graham so exercised, and it gets me very exercised too. It gets you very
yeah,
exercised too. We're
yeah.
all offended by the lack of justice in this particular situation.
I did not think of that before. So the Fed manages the banking system as a collective, as a collective.
As a
That's
collective, and their
that's
job
critical.
is not to see that justice is done. Their job is just to stabilize the collective, come what may.
Interesting. Not to see that justice is done. Not to see that justice is done.
He said,
And that another excellent point. Justice is done. And that if they require constant backstopping by the government, which means the public, which means us, then are they really private companies to begin with?
well, okay, I certainly don't think the Fed banks are private companies to begin with, okay, in any meaningful
Or
sense.
deserve to be?
Right. But certainly, the banks that are part of the Federal Reserve System, the banks that we deal with, okay, at the corner, okay, the commercial banks, they certainly are not like the ideal of private companies operating in a free competitive market. They
These
are
big,
operating in a managed market, which is managed by the Federal Reserve to protect their stability,
yeah, okay,
even when they engage in wrongdoing.
okay. But the larger point of just big corporations doing horrible things need constant backstopping by society, and yet they are the ones that are, I got it, that's really interesting. That's very helpful. Okay. uh okay, I have only a few more. I have to stop myself. I'm going to stop myself, Joe, and say goodnight.
Okay, we're at, okay, 11:11, so, okay, I think it's time to stop.
I agree.
Okay,
I agree.
I'm afraid there are many, many good comments here, but I'm going to have to content myself with reading them over tomorrow,
Yes, I will look through it as well.
and maybe spend some time in actually replying to some of the comments. Thank you all for all the comments. Thank you all for staying. Thank you all for being here. Uh, and thank you all for all the comments. They're really good. And I will be going over them tomorrow.
Joe, you're really patient. I have a lot to learn, and you're very patient, and I appreciate it. I am learning a lot. I'm really learning a lot. I feel like, I don't know if I think I said this to you, that you learn, you see like all these branches, and then you learn all those branches, but you realize that once you go in, it's fractal. It's the same damn thing.
It's right.
No matter how much you learn, there's always an infinite amount to learn.
Yeah.
But I feel like, yeah, these past conversations have been really, really enlightening. I appreciate it. I appreciate your time.
Okay, well, we can have another one soon and keep on drilling down into this until everybody understands the financial system that we have, and especially where the Congress comes in.
Great. Actually, if I may, I am talking with Graham on Monday.
Okay.
Because I want to introduce him to these concepts. And I was actually very afraid that although I knew, I had a feeling of what was going on, obviously I was missing a lot. And I'm hoping to give just a decent overview, and then encourage him to hopefully speak with you at some point to go deeper, because I feel like he's really got the basics now. He's really got the basics, and I feel like it's now that he's starting to go into these deeper subjects that I think he's ready for more, which is exciting. So
Okay. Well, thanks, Jeff.
have a good night. Bye, everybody.
I'll see you next time.
Great. Thank you. See you later.
Okay. Bye, folks.